You're watching the Daily Market Comment here at xm.com by Haralambos Pisuros. I'm Christina Marujos. The US dollar continued tumbling on Tuesday and during the Asian session Wednesday, losing ground against all the other major currencies. Perhaps traders are positioning for another soft US CPI report later today, as expectations are for both the headline and core CPI rates to have declined further in June. The latest retreat has taken the dollar index to the key support zone of 100.70, which has been acting as a floor since February. A potential miss could result in a dip below that strong line of defense and turn the broader outlook back to bearish, as the inflation data may convince investors that only one more hike may be enough to mark the end of this tightening cycle and that a series of rate cuts for next year are appropriate. On the other hand, an upside surprise could leave the picture neutral for a while longer. With the yield differentials between the United States and Japan narrowing even further, the Japanese yen has been in the driver's seat in the FX market, taking dollar-yen below the 140 zone. The risk-linked Aussie and Kiwi are also winning against the US dollar today, despite the RBNZ keeping interest rates unchanged and signaling that they may need to be kept there for the foreseeable future. Later in the day, the central bank torch will be passed to the Bank of Canada, which is largely expected to proceed with a 25 basis points hike. However, the larger-than-expected slowdown in Canada's inflation may result in downside revisions in the bank's updated projections, which would add a dovish flavor to a potential hike and may hurt the loonie. Just a day ahead of the all-important US CPI report, Wall Street enjoyed gains as investors are likely preparing for another cool-down in price pressures. If indeed the report confirms that inflation in the US is coming down faster than previously anticipated, equities are likely to continue trending north for a while longer. Most tech companies that have been the drivers of the stock rally that started in October are considered very expensive from a valuations perspective. However, expectations of deeper cuts by the Fed next year could keep their present values high and thereby their stock supported. The slide on the greenback and U.S. Treasury yields allowed gold to briefly poke its nose above the key barrier of 1935. A large slowdown in today's inflation data could encourage the bulls to clear that level and perhaps start marching towards the next key resistance area at around 1975. This was a Daily Market Comment. Thanks for watching at xm.com.